All right, well, welcome to the Dream Home Dream Team First Time Homebuyer Workshop. I am Skip Roberts. I will be presenting along with Rick Rogers. I have been doing real estate for 8 years now, and I am the father of 4 girls. It's a lot of girls. And I love skiing, golfing. I love hunting. I love being in the outdoors. I love to do all kinds of outdoor activities. So that's me. So tonight we're going to be talking about the current market status, what's going on out there. We'll do a step-by-step of the home buying process. We'll highlight some of the real estate purchase contract, a few of those, and then we'll turn the time over to Rick to talk about the loan process. So I handed out the real estate purchase contract. So the first one we're going to talk about here is earnest money. Earnest money is extremely important. It's a lot like a rental deposit. It's money you put down that holds the property, and you have several opportunities to get that, to cancel the contract and get that money back to you. And that's one of my jobs as your realtor, is to protect that earnest money like it's my own child, because no one likes to lose earnest money, whether it's $500 or $5,000. Typically, right now, earnest money people like to see is like 1%. So if a home is $300,000, then if you can do $3,000, that's good earnest money. But typically, $1,000 is plenty. The market right now is extremely crazy. We're getting multiple offers on in that first-time home buyer price range, anywhere from $300,000 to $400,000. They're getting offers like 5-8 offers in the first day. So it's good to have somebody on your team that has the experience and the knowledge and the know-how to make it to get you under contract on that home that you want, and have fun while you're doing it. We'll refer back to earnest money a lot in this presentation. So next up is the purchase price. Right now, the purchase price on a first-time home buyer is, on a starter home, is that anywhere from, on a townhouse, looking from $250,000 to $350,000. On a single-family home, you're looking about $300,000 to $400,000 on that. So it's a little wild out there right now. I never thought a starter home would be close to $400,000. Section 3.3, you see the possession. That can cause a lot of headaches for people. So there's 3 options. You got upon recording, hours after recording, and blank calendar days after recording. So if a home is occupied, if people are living in it and they have to move out, I will usually put 48 hours. If it's empty, it's vacant, I'll do upon recording. So a lot of people, when they go in to sign all the paperwork, they think that's closing. They sign the papers and then they get the keys. It's not quite how it is. So usually you will go in and sign, and then the next day the lender will transfer the money over to the title company and disperse the funds, and then they'll change the name on the title. And that's called funding and recording. And so that's when you actually get the keys. A lot of times, so sometimes it can be on that same day, but most times we plan for it being the next day. So I like to have everybody sign everything on a Wednesday, especially if the home is occupied, because you got that 48 hours. So we sign on Wednesday, the funds records on that Thursday, then 48 hours they can move in on that Saturday, Sunday. They can have the weekend, so they're not missing out on work stuff. So page 6, the contract deadlines. This is where, to go back and reference earnest money, this is how we protect the earnest money. So you have 4 deadlines. You got the seller disclosure deadlines, you got the buyer due diligence deadlines, financing appraisal, and settlement. The sellers will fill out a disclosure form that reveals everything that they've done to the house, like remodels, improvements, damages, floods, anything and everything. And so you can look at that. It's like a 6 or 7 page document, and anything they answer yes to will have an explanation. If there's a big red flag on that, say the foundation shifted, I mean, that's a big red flag right there. So that gives you reason to cancel and get that earnest money back. The second one is the due diligence deadline. That's when you do the home inspection. You bring in a home inspector. That home inspection fee is usually $300 to $400, and he checks the appliances, the roof, from top to bottom, inside and out, and he checks to make sure that anything on that they answered yes to, he'll check out, make sure it was done professionally, like a repair was done, a remodel was done professionally. It wasn't like a weekend YouTuber job. So he makes sure everything's done right. And if there's any major repairs that we can't negotiate them to fix for you, then you can also have that time to cancel. If they're not going to work with you or anything, you can cancel at that time based on your buyer due diligence and get that earnest money back. The third one, financial and appraisal deadline. That is, you can cancel based on if the appraisal comes in lower and they won't negotiate down to the appraisals. That's the thing with this market. Since there's multiple offers, people will put down higher and higher offers, and appraisers they're not saying no. People are offering ridiculous, like 40, 50 grand over asking price, but it doesn't appraise. So that's when we have to go back. Appraisal comes in low, we have to go, hey, Mr. and Mrs. Seller, your home only appraised for like $10,000 over asking price. So we need the bank's not going to lend any more money than what the home's worth. So you have the option to bring the difference in cash. And most first-time home buyers don't have a lot of extra cash laying around. They barely have enough to make the down payment. So we usually just see if the sellers will negotiate down to the actual appraised cost, and if they don't, then we can cancel, get your earnest money back. Then you can cancel based on financing. If financing falls through or you don't like the loan officer you're working with, you'll love Rick because Rick's the best. So you can, like I said, if financing falls through, you can cancel, get that earnest money back. So that we usually do seller disclosures. You have a week to get back out for that, 14 days for buyer due diligence, and 3 weeks for financing appraisal. And then we like to close within 30 to 35 days. So you can still cancel in between financing and appraisal deadline and settlement, but you will forfeit the earnest money at that point. So we basically have 3 weeks in a transaction to make sure all of our ducks are in a row, the appraisal's in, home inspection's done, the underwriting has approved all the documents needed, and by then we know whether, if we're close on things, we can always extend that date, and that's my job, is to make sure we protect your earnest money if there's a hiccup along the way, because there are hiccups that come up, and we handle them really well. And that's when I go to the other real estate agents and say, hey, the appraisal isn't in yet. They're really backed up with refinances right now. They should have the appraisal. The appraisal's been done, but we just haven't got it back. We should get it back within the next day or two. Will you extend 2 days for us? And 9.5 times out of 10, they say yes. They're really easy to work with, and so we just do that. We're not pushing back the closing date, and we're going to keep that. We just need a couple extra days for this reason. So just to wrap up, the out-of-pocket fee. So we'll say you put $1,000 down for earnest money. You have to write a cashier's check or a personal check that goes to my brokerage. We hold it here in our trust account. And then you have the home inspection fee, which is, it can range from anywhere to $300 to $500 even, I've seen, but I've got a couple inspectors that I refer people to. One's $300 and one's $350. They're both great. Then a home inspection, Rick can talk more about this, but usually they're ranging from about $400 to $500. Is that right? So you can typically like $1,800 to $2,000 out of pocket. The home inspectors will take a credit card, debit card, cash, Venmo, whatever. And I think the appraisal can be a credit or a debit card as well. So basically, just need the hard money for the earnest money, and that earnest money goes towards the final purchase price. So if you cancel, you get it back, but if you go through with the loan, say it's $300,000 and 1,000 earnest money, your loan will be $299,000 plus whatever. I won't get into the math right now because I'm not a math guy. Anyway, that's it for me. I appreciate your time. We'll turn the time over to Rick to go over the different loan programs and a little bit of credit repair stuff. So thank you.
So thank you, Skip, for that introduction. We're going to talk to you about the home buying process from the perspective of getting financing. So most people, when you're going to buy a house, you just don't have enough cash to sit down and hand someone $300,000, $400,000. So most people require a loan. So my job is that of a mortgage broker, which means I don't lend my own money. I don't represent an institution, a bank or a lender that lends their money. I go out and I shop around different banks and lenders that specifically lend money for home mortgages to find the best deal for my clients. So we have contracts with anybody that really matters out there in the mortgage world. A lot of names that you've heard of, many names that you haven't. So all of those institutions are going to look at the home buying process through the same qualifications, and we'll kind of talk about those. But first thing I want to do is kind of walk through what that process looks like. So when we first talk to someone who's looking to buy a house, my job is to gather all of the information about your situation. We'll talk about what information that's going to cover. Then I start going out and shopping to different lenders, finding one that works to meet your goals and give you the best terms possible for the goals that you've got with that property. And then we walk you through the process from start to finish. Myself or my team is going to help every step of the way, gathering that information, answering questions, giving you updates on where you're at through the process, and making it as smooth a process as possible. Now, Skip alluded to earlier that there's going to be some bumps along the road, or there can be bumps along the road. Oftentimes there are surprises. Our job is to handle as many of those surprises that come up before they even get to you and answer those questions. So the process when we're gathering that information, banks are looking for information in 4 different categories. One is your credit. So most people know what their credit score is. You can get freecreditreport.com. You can go to Credit Karma and kind of know where your score is at. The credit report that we pull for your mortgage is a mortgage-specific credit report, which means the numbers are going to be a little bit different than what you might see. We pull credit reports from all 3 credit bureaus. We take the high one and we toss it out. We take the low one and toss it out, and we use the middle score for your credit score for a loan. So the second thing after credit is the collateral for the loan. So when you go through the loan process, we're going to order an appraisal to verify that the amount that the bank is lending you matches up to the value of the property. They're not going to lend you $1 million on a property that's worth $400,000, right? The bank wants to make sure that in worst case scenario where you can't make your house payment and they have to take over a property, there's enough value there that they can sell it and make back their money. And for your protection as a buyer, you want to make sure that you're not overpaying for a piece of property that was maybe marketed a little bit better than another one, but really doesn't have the value there in the home. And your realtor's job and my job is to make sure we protect that, and the bank's going to look at the collateral. So part of that collateral also is your down payment. How much skin do you have in the game? So if you buy a house for $400,000, the bank generally is going to expect you to have at least 3.5%, if not 5%, 10, 15, or 20% down payment. And there's very specific reasons I use those percentages, because your loan gets better the more you put down. The more skin you have in the game, the less risk there is for the bank that you're just going to walk away from it, because they really don't want your house, then the more likelihood that you're going to make that house payment. So we're looking at your credit, the collateral for the loan, which includes the value of the home and your down payment, and the next is your capacity to make a loan payment. Right? The bank wants to make sure that you have the ability, that you earn enough money to cover the house payment, and they have their own calculation on covering the house payment as well as the other debts that you've got. So we pull your credit report, we find out how much you pay for your car payment and your credit cards and your student loans if there are anything that shows up on your credit report. And then they take what your new house payment's going to be, and they find out how much all those things together are as a percentage of your income. And they use your gross income. So if your salary is $60,000 a year, they calculate it based off of what that salary is, not what your after-tax income is. So after we gather information on your credit and collateral and your capacity, the last category is your character. The reason we say character is the only way I can classify that, so we use 4 C's. And basically we're just getting a history of the last couple of years. Where have you lived for the last 2 years? Where have you worked for the last 2 years? Are you stable in your employment? Are you who you say you are, right? We ask to get a copy of your ID, make sure that that matches with who you told us you are, and a few other things. So once we gather all that information, we go around and we find a bank that's going to provide you the best terms for your loan. And those terms are very important. So when I got into the mortgage industry, part of the reason I did so is because I thought I could do a better job than the guy who got me my first mortgage. I asked him for the lowest house payment. I wanted the lowest house payment possible. And so he put me in one of these things called a variable interest rate, interest-only loan, which meant my house payment wasn't covering any principal on each house payment, and my interest rate was going to change, but it was the lowest house payment I could have. I got what I asked for, not what I really wanted. And so one of my roles is to make sure we understand what your goals are with that property. How long are you going to live there? Are you going to turn it into a rental property maybe down the road? Are we looking for the absolute lowest payment? Or are we trying to pay it off a lot faster? Are you nearing retirement and wanting to have that house paid off before you retire? And the type of loan that we get for you is going to be determined really by what you want to achieve. And we'll show you different options on how you can achieve that goal. So different types of loans. Beyond that, there are different loan programs that exist out there. You may have heard things like USDA loans or FHA loans or VA loans, or you'll hear advertisement for, back in the day, it was Obama's going to help you pay your mortgage. There's different government-backed programs or government-sponsored programs. Generally speaking, different loans are based upon where the house is located, whether or not you have government service, and what kind of specials are going out there right now. But it's going to help determine what your interest rate is, what other aspects of the mortgage payment, things like mortgage insurance. We don't have too much time to talk about that tonight, but if you don't have a big enough down payment, a bank's going to want to have a guarantee that if you don't make your payment, they can recoup their costs. So they're going to make you buy an insurance policy against the risk of you foreclosing, and include that in your payment. And different types of loans like FHA, VA, or conventional loans are going to have different charges for those. So our job is really to help navigate that, walk you through specifically the options that might be good for your scenario, and help you make the decision that lines up mostly with your goals. So for those people who come to us and maybe don't have the greatest credit in the world, or they're not prepared to buy a house, you don't necessarily know that until you've talked to someone, until you've had a mortgage-specific credit report pulled. So we've had experience in the past where we have clients come to us and want to buy a house but not know where to start. So we'll start with gathering that information and pulling a credit report. And if for some reason there's information on there that's going to prevent a bank from lending that person a loan, for example, when I went to go buy my first house, the lender came back and says, sorry, we can't do a home loan for you. You're behind on your child support. Well, I was 24 years old and I never had a child, and I wasn't a 45-year-old man living in Florida, but my credit report said I was, so we had to go back through and fix that. So first thing we do is start with that report so that if there are issues like that, we can fix them. Some of those issues can be fixed in days. Some of them can be fixed in weeks. Some of them take a little bit longer to clear things up and get things where they need to be. And there's different programs that we have access to, both internally as well as third party, and in certain cases that we can access it. I'm going to go ahead and talk about a couple of the other aspects that are here on the board. We sometimes bring in an insurance agent to talk about homeowners insurance. I'm actually licensed to be able to do that, even though I don't do any homeowners insurance. But part of your house payment includes, generally, unless you do an interest-only loan, a portion of your house payment includes a principal payment to pay down your loan amount, an interest payment, which pays the bank for lending you their money, an insurance portion, and that's homeowners insurance, which pays for if the house burns to the ground. The bank wants to make sure that you have an insurance policy in place so that there's still a house there that they could sell if you stopped making your house payments, and your taxes, right? So the bank would lose their opportunity to take the house back from you if you didn't pay your taxes, because the government would step in and take that house. And so the bank's nice enough to make sure your insurance and taxes are paid as part of your house payment. and they also might have mortgage insurance there. But homeowners insurance is going to be a requirement for anyone who buys a home for that reason. And we'll help line you up with very wonderful, competent insurance agents, and even help you shop around a little bit if you don't have an insurance agent that you already like. The other piece is a title company. So you have the opportunity to choose your realtor, like Skip, who does a great job, your mortgage person, like us as a broker, who tend to be able to shop and get you a loan done faster and with lower costs and interest rate. You also have the opportunity to choose your own title company. Skip and I have great relationships with some of the best title companies in the area. But that title company is going to be part of the transaction. They're going to be the place where you go to sign all of the loan documents at the very end. So once you've got the house under contract and we've walked through the loan process, we've had the loan underwritten and approved by the bank, and they prepare all the documents, you're going to sit down with a third party who helps explain those documents to you, explain all the numbers in the transaction, and their job is to grab all the money from the bank as well as your down payment and disperse it to the seller. They make sure your realtor gets paid. They make sure that the loan that the seller has, if there is any, gets paid and taken care of, and disperse all those funds and take care of all the documents. They also are the ones who record with the county that you are now the new owner with the home. And so that the house is in your name, and they verify those things, and they'll give you a copy of all those documents. So that's kind of a brief summary, a very quick summary on the loan process, the different pieces of documentation that we're going to gather, who's involved in the transaction. Generally speaking, for people who are buying a house for the first time, it can be kind of intimidating. It's hard for someone who maybe doesn't know anything about mortgage insurance and housing insurance and a title company and a real estate agent and earnest money and appraisals and inspections to know how all that's going to work. That's where a competent team, Skip and I together, comprise the Dream Home Dream Team. And our teams that help back us up make sure that we walk you through each of those steps, explain each of those steps to you, answer your questions, and give you an experience that hopefully is a wonderful experience getting you into the house of your dreams, or helping get you into a starter home and then into the home of your dreams. So with that, appreciate your time. Please let us know if there's any questions we can answer for you.